So my talk today is actually going to cover 3 research papers that I've done, the first of which appears in the proceedings to this conference. And a little bit about me. I was a derivatives trader and worked in the derivatives markets for over 15 years. And I was an early Bitcoin adopter. So naturally, when I looked to evaluate value formation in Bitcoin, I approached it from the point of view of a financial asset. But there was a lot of noise in the price between Bitcoins and dollars. And as you all know, the volatility of the price over the past few years has been enormous. And that makes doing any sort of meaningful data analysis to extract these drivers of value very, very difficult. But fortunately, there's this whole universe of altcoins that have relatively active and fairly liquid markets that trade against Bitcoin and are denominated in Bitcoin. So we strip out the dollar, and we're looking now at a universe of only Bitcoin-denominated space. And here, all that noise is removed, and the price volatility is much lower. For example, 1 Bitcoin equals 1 Bitcoin, always, in this space. So what do I mean by value? So the market price at any point in time is dictated by fluctuations in supply and demand and the imbalances that are seen in the market. Value is a center of gravity around which prices tend to fluctuate, and it's kind of a theoretical value. The market price can deviate from that expected value for long periods of time, and it may never converge to that value. So just to get that out of the way, because it's always asked. So looking at all these cryptocurrencies that have a common lineage to Bitcoin, there's a rich data set of some common attributes that they all have. And by examining differences in the values of these attributes of all these different cryptocurrencies, I was able to run a multiple regression analysis that determined which of these matter in relative price formation and which of them didn't. Going into it, I thought all of them could feasibly matter. The block reward is the number of coins found per block. The block time is how many minutes or seconds between blocks, and so forth. Those are all built in. There's also observed variables that we can only see by looking at the market, such as the price and the aggregate hashing power, which manifests itself indirectly through the difficulty of mining. So, looked at 66 different cryptocurrencies that were actively traded and ran a multiple regression that had an R-square of 84.4. This means that almost 85% of relative value formation is explained by the following. Mining difficulty is positively correlated to value. The more hashing power that's in there, the greater the difficulty, the more valuable a coin is. The more people mining a coin, the more valuable it is kind of intuitive. The rate of unit formation is negatively correlated to value. This means that if I have a block reward of 10,000 for some altcoin, it's going to be a lot less valuable per unit than something that's 1/100th of a coin. And the other one that mattered was script is more valuable than SHA coins, all else equal. It's a more rigorous mining algorithm. It means that it's harder to find those coins with a harder algorithm. Money supply did not matter, and this surprised me. It didn't matter that Bitcoin has 21 million coins ever to be, or a pure coin has an infinite amount, or some coins only have 42, for example. That was irrelevant, and what was also irrelevant in the statistical analysis was how long the coin has been around. It didn't matter if it was 4 or 5 years or 1 or 2 years. So the main drivers of cryptocurrency relative value formation are taking place at the margin and have to do with the production of them and the relative differences in how many units are produced through a given amount of mining effort. So starting to look less like something like a currency and more that's something akin to commodity production. So just it's important to bring up now that Bitcoin is the stable equilibrium for cryptocurrencies, meaning that it's the most widely accepted by people in the marketplace. It has the largest mining network. If you want to transact meaningfully in an economic way with cryptocurrencies, you need to get Bitcoins. And if that means by buying them, by mining them directly or indirectly through altcoins, it doesn't matter that it may be technically inferior to some other altcoins. It's very hard to dislodge that stable equilibrium. For example, VHS over Betamax and QWERTY keyboards and internal combustion engines are all examples of this in real life. So this equation tells you how many Bitcoins a miner can expect to earn per day for 1 terahash of mining power, and we're just going to use a standard of 1 terahash just to make it easy. Bitcoins per day is a function of the block reward, the mining power, and the difficulty, and that's it. Those other numbers are constants that scale it up for days and that take the maximum difficulty, theoretical difficulty, and scale it down with 256-bit encryption. That's why you see 2 to the 32. But the variables there, and we're pegging the 1 terahash, and the block reward we know is 25, is the difficulty. So because that if you want to spend cryptocurrencies to transact, you need bitcoins, at least right now. So if a miner can produce effectively more bitcoins a day by mining for some altcoin and then exchanging them in the market, they will do that versus mining for Bitcoin directly. And if not, they will mine for Bitcoin directly. Because again, value formation on this level is only formed by production. So it's the producers who matter. Let's take an example. A rig that mines 1 Bitcoin a day can alternatively produce 33,000 of some hypothetical XYZ coin a day. And if the market bid on, let's say, Cryptocurrencies or a similar exchange is 3,996 Satoshi, you can sell those and get effectively 32% more Bitcoin a day than by mining Bitcoin. But these opportunities are very short-lived, because as people see this opportunity, they go in, produce these coins, sell them in the market, keep selling them until the equilibrium price is reached. In this case would be 3,030 Satoshi. But another thing's at work. Additional mining power brought into these small altcoins will increase the difficulty, which will make it harder and harder to find them, making that profit opportunity less and less. So what's the implication? Well, at the fundamental level, altcoins will tend to fall over time in value relative to Bitcoin. And furthermore, at specific moments, such as when Bitcoin's difficulty increases, we should see this effect happen more pronounced. Because if I can mine 1 Bitcoin a day, or 33,000 XYZ a day, and it's 30 Satoshi versus 1 Bitcoin, I'm indifferent. But if the difficulty of Bitcoin mining increases and I can only find 0.9 a day, that makes the 30 Satoshi price attractive again, because that's 10% more Bitcoins effectively. So if we see Bitcoin difficulty increases, we should see altcoins get pushed down even more so. We also have the problem of overshooting, which has to do with the market price being continuous and the difficulty adjustments being incremental. And there's also a time lag with confirmations. Some of these altcoins take a long time to go from mining to a wallet to an exchange and then trade. So here's just some examples of real-world market data of some of the most popularly traded altcoins in the last 6 months. And they're all down significantly. Here's 6 more. So going back to my first question that I wanted to figure out, what is the underlying value of Bitcoin in dollars? But now looking at it from this new perspective, from a cost of production perspective, I have to identify, well, what is the cost for producing Bitcoins? And that, as everyone knows, is the cost of electricity. So right now you have to pay for electricity in dollars, but you produce Bitcoins that are in Bitcoin. And according to economic theory, in a competitive production market, marginal cost is going to equal marginal product, which is going to equal selling price. Because our cost term is in dollars per gigahash per day, and our product is in Bitcoins per gigahash per day, if we divide cost by the product, we're dividing equivalents, that's just 1, but we'd get scaled up to put it back into dollars per Bitcoin space. So let's do a little example. Let's say the average world electricity cost is 11.5 cents per kilowatt hour, and the average mining efficiency on the Bitcoin network right now is a little under 1 watt per gigahash second, which is the same as a joule per gigahash. And we already saw that Bitcoins per day with 1 terahash, you'd expect to find a little more than 1/100th of a Bitcoin a day. Divide the marginal cost by the marginal product, and you get a number that's very close to the market price of Bitcoin. If you do the math yourself, you'll see there's a small rounding error. I think it's off by like 11 cents because I rounded the denominator. But the point is that this, for looking at it not like money, not like a financial asset, but as a commodity produced in a competitive market, using economic theory that way, you actually get a very good and justifiable beginnings of understanding value. So there's implications if this is true. So as mining becomes more energy efficient, and it has by leaps and bounds, the amount of technological progress in mining hardware has gone faster than any other. They compared it to the growth of the internet and the .com, and they say that this has gone even faster. As mining efficiency increases, it's going to put downward pressure on the market price of Bitcoin in dollars, because lower and lower cost producers will exist that can be profitable at prices of $180, $150, $140, and they can still continue to earn a profit, while those that are stuck around now, $243 on the margin, would effectively be operating at a loss, so they would stop. Difficulty adjustments counteract this tendency, however. So unlike a traditional commodity where supply can be augmented or decreased in order to accommodate changes in demand, Bitcoins are always produced at one block every 10 minutes. It's the difficulty that acts as an elasticity in a certain way that will go up and down, making the cost of production higher as the difficulty increases. When the block reward is halved, it will actually do this to a severe extent. It will double the cost of production overnight, presumably. So these are just objective, quantifiable valuation insights. And Bitcoins and altcoins obviously possess additional subjective values as well that are very hard to identify and quantify. But people are speculating, miners are hoarding. This model of production assumes that people are mining to produce. They're producing to sell. That's not true. Some miners keep all or some of their product. There's community and brand loyalty. For example, Dogecoin has a huge loyalty behind it, even though fundamentally it's fairly worthless based upon this mathematics. And there's value in the unique features of cryptocurrencies, such as the decentralized nature, that it's anonymous, that it's fairly secure, and so on. So if it's a commodity with an exchange value, it should also have a use value. And I don't want to use these classical political economy terms loosely, but what I mean is that if you're going to have mining effort in order to find this commodity, there must be a use for it. And the use is actually the mining work itself. So as we know, mining has a dual purpose. It finds new Bitcoins, but it also verifies transactions and secures the blockchain. And this is extremely valuable because it prevents things like double spend, which would render it useless as a currency or as a means of exchange. So the Bitcoin network is a giant validation engine. You can look at it as a payments network, but it's a giant validation engine. And mining is a misnomer. It's validation work. So up until recently, the validation work has been verifying internal Bitcoin transactions between wallets. And while that is of some value, what's of more value is when Bitcoin 2.0 applications become more prevalent, and you can now embed and validate external transactions in the Bitcoin blockchain through mining effort. So imagine a case where you can IPO shares onto the blockchain or settle financial transactions onto the blockchain. These things have enormous value in our real economy, and if they're occurring not at stock exchanges and through investment banks, but on the blockchain, mining and miners are going to want to be paid a value commensurate to the value of this validation work. And that is going to be the future value, I believe, of Bitcoin, and that's where you're going to see this subjective piece become more interesting, and I think that's where a lot more research is going to be headed. One thing I'll leave you with then is Bitcoins might not be money then. They might have been intended to be money, but that's not how they're behaving. And they might not even be a commodity. In fact, I think one way to think about Bitcoins is that they are tokens earned for the reward for doing verification and validation work. And I'll leave you guys with that. I have a couple minutes if anyone has any questions.
Thank you. Thank you very much for bringing these additional factors to my attention and to our attention. I'm a coin designer, so I made decisions a few months ago as the specifications of a coin that I thought would lead to maximum value. And some of your points have confirmed my decisions. Over the past 18 months in Bitcoin Talk Forum, independently, 2 researchers there proposed valuation models. And I wondered if you had looked at those. So the idea was Metcalfe's law for networks, that the value of the network is proportional to the square of number of nodes. So the analogy was that the users or the number of transactions was indicative of the number of nodes in the Bitcoin network. And they found a very strong correlation between 2 data series and the price of Bitcoin over the life of Bitcoin. The first was the quantity of transactions reported by blockchain info excluding popular addresses. And the second was the number of wallets, also reported by blockchain info. There was a very strong correlation between quantity of transactions and the number of wallets proportional to the square of those. So as an altcoin designer, my objective to maximize the value of the altcoin would be to maximize the number of transactions and the number of users. Your thoughts?
Well, transaction data is hard to pin down because you don't know what is a real economic transaction, and presumably those are the transactions that will be meaningful for value. If someone's transferring whatever they mined in their day from their mining wallet to their cold storage wallet and then take it off to put it onto a cryptocurrency exchange, that might look like a lot of volume, when in fact there's not any meaningful transactions. That's why I brought up the point that in order to transact in the real world, right now you need to convert into Bitcoin. To a smaller extent, Litecoin and Dogecoin, but not really. This is the Texas Bitcoin Conference. It's not the altcoin conference, for example. And that, again, is just a product of path dependency. You can make a far superior altcoin technologically with features that are perceived subjectively as valuable. However, it is very hard to dislodge that stable equilibrium once it's been established.
I have a quick question. Have you considered the tax benefit obtained for the valuation of a Bitcoin?
I'm not a tax advisor, but I don't know if classifying it as a produced commodity versus a financial asset would have tax implications. You should speak with the gentleman that gave the speech on taxes earlier.
Because what this is an intuitive thing that I've had for a long time, is that obviously the expense of producing my electricity is tax deductible, and the benefit is not.
This is beyond my realm of expertise, but I would imagine that there might be a difference. I just don't know what it would be.
Yeah.
Would it be a fair conclusion from this research to say that there is a tendency for the rate of profit for mining Bitcoin to fall, given the increase in difficulty and the limitations built into Bitcoin as a protocol itself?
Well, I want to be very careful in identifying a rate of profit versus the price or the value. The rate of profit in Bitcoin is hard to pin down because the rate of profit is the own return of 1 terahash of mining power. So per day, your profit is a little over 100th of a Bitcoin a day of profit. If you increase your electrical efficiency, you're still going to produce with 1 terahash of mining power. However, when the difficulty changes, that will affect how many you find per day given that same amount of power. So it's hard to say what is a rate of profit in a Bitcoin internal sense.
So would it then be another reasonable conclusion to say that at the very least it will drive miners to seek constantly places to run mining operations where the electricity costs are lower?
Yes. And you see that already, where there's big mining warehouses in places like Iceland, where it's very cheap geothermal electricity. But what matters is the regulating values are the average across the network. Because you're going to have people producing on the margin, you're going to have people producing below the margin. The people that are producing at a very high energy efficiency at this point in time are earning economic rent. So they're earning excess profits. Over time, as the people that are producing on the margin get booted out by the market, essentially, then we will see the price start to converge. Now, there's going to be a seesaw between increasing energy efficiency, which is going to put a negative pressure on the dollar price, and the halving of the block reward and increases in difficulty, which will tend to counteract that. and I don't know which will win out.
Thank you.
All right. I have time for one more question, I've been told. Yes.
So I guess this goes into another question that was already raised. So how would the government regulation are affecting this? Because like it was said, you don't know how many coins are moving from one wallet to another, and there are a lot of these statistics just get skewed every 6 months due to differences in government regulations.
Right, and that's why the beginning of the analysis stripped away the dollar, euro, yen, won price. It was looking at internal Bitcoin economy, let's call it only, where Bitcoin was the base currency. And by doing so, it didn't matter whether or not the price of Bitcoin rose or fell, because one Bitcoin would equal one Bitcoin. Well, thank you very much. The papers are available for you to read. The other two, if you're interested, just find me and I'll give you the links. Thank you.